All right, welcome back. Today, we're diving deep into the financial books of a rapidly scaling defense contractor to explore a pretty fascinating phenomenon. I like to call it the growth paradox. It's this wild look at how a company can look absolutely like a rocket ship on paper while quietly fighting a massive battle behind the scenes just to keep the lights on.
So think about this for a second. What actually happens to a company's finances when their main gig is building literally massive, incredibly complex machinery for Navy submarines? We're not talking about selling software subscriptions here or flipping retail consumer goods. We are talking about giant physical products, really long manufacturing cycles, and dealing with one of the most notoriously slow-paying customers on the planet, the government. This specific dynamic creates a very intense financial reality.
Well, to really get a handle on this reality, we've got to look at what's called a restated financial statement. The numbers we're pulling for today's explainer come directly from a prospectus prepared by CFF Fluid Control Limited for their upcoming Further Public Offer, or FPO. See, when a company goes to the public markets to ask for more money, they can't just hand over their messy, day-to-day accounting books. They have to standardize and adjust everything so that potential investors can make a clean, apples-to-apples comparison across multiple years.
And look, just to be absolutely clear up front, we aren't looking at some slick marketing brochure here. These numbers have been strictly audited and verified by VN Purohit & Company, a firm of chartered accountants. They've legally signed off on the accuracy of these restated statements for the fiscal years ending in March 2023, 2024, and 2025. So the data we are parsing through today is as rock solid and highly scrutinized as it gets.
Section 1. Who is CFF Fluid Control? The mechanics of defense.
So what do they actually do? Well, CFF Fluid Control operates deep in the naval defense sector. They manufacture, overhaul, repair, and maintain heavy shipboard machinery. We're talking about crucial combat systems, highly sensitive reference systems, and really complex pneumatic, hydraulic, and electrical test facilities. Their main end user is the Indian Navy, and they service both submarines and surface ships. This is capital-intensive, high-stakes engineering. I mean, when you are building parts for a submarine at the bottom of the ocean, there is absolutely zero margin for error, and the materials you need are incredibly expensive and highly specialized.
Section 2. Booming revenue and profits. The flashy top line. Seriously, just look at the sheer velocity of this growth. In FY23, the revenue from operations was just over 7,000 lakhs. By FY24, it jumped right past 10,000, and by FY25, a staggering 14,556 lakhs. In just 2 short years, they've more than doubled their top line. By pretty much any conventional metric, this is explosive, highly successful growth. They're winning massive contracts, and clearly, they are delivering on them. And the best part? That revenue growth is actually translating beautifully to the bottom line. For the fiscal year ending March 31, 2025, CFF Fluid Control reported a net profit of 2,385.03 lakhs. That is a massive, incredibly healthy number for a company of this size. On paper, they look highly profitable, which proves their defense contracting business model works and generates some really significant margins. Honestly, if you stopped reading the financial statement right here, you'd think they had absolutely nothing to worry about.
Section 3. Building the balance sheet. The structural foundation.
But here's where things get really interesting. Let's look closely at where that wealth actually lives. For FY25, they have nearly 6,000 lakhs tied up in inventories and another 6,000 lakhs tied up in trade receivables. Now compare that to their physical property, plant, and equipment, which sits way down around 2,700 lakhs. This means the vast majority of this company's wealth is currently sitting in unfinished submarine parts in a warehouse somewhere or in invoices just waiting to be paid.
And if you track the trend over time, it's honestly staggering. Trade receivables, which is just money owed to the company for completed work, hovered around 800 lakhs in both FY23 and FY24. But in FY25, it skyrocketed to nearly 6,000 lakhs. Meanwhile, their inventory has just steadily marched upward year after year, growing from 3,700 lakhs to almost 6,000 lakhs. So they're building more stuff, and they're billing for more stuff, but the actual physical cash, it hasn't hit their bank account yet.
Section 4. The cash flow catch. The plot twist.
Right, so here is the massive juxtaposition. On paper, they've got this glowing net profit for FY25 of over 2,300 lakhs. But if we pull from the cash flow statement, which tracks the actual cash entering and leaving the bank accounts, their net cash from operating activities is negative 321.77 lakhs. So how on earth does a company make over 2,300 lakhs in profit but actually lose cash from its day-to-day operations?
So what's the culprit? In a word, working capital. Think about it like this. When CFF Fluid Control builds a submarine system, they have to front the cold, hard cash for the raw materials and the payroll today. They get to recognize the revenue when the product is officially delivered, which creates that massive paper profit. But if the government takes 9 months to actually pay the invoice, the company is essentially starved of actual cash in the meantime.
So when we look at FY25 specifically, because their trade receivables blew up so massively, that literally counts as a negative adjustment to cash of over 5,000 lakhs. On top of that, they spent over 700 lakhs building up more inventory to fulfill future orders. All of this cash is completely trapped. It's essentially buried treasure. The company is objectively wealthy, but it is definitely not liquid.
Section 5. Funding the fleet. Financing the paradox.
To bridge this giant cash gap, CFF Fluid Control has to lean heavily on outside financing. I mean heavily. In FY25 alone, they utilized over 1,600 lakhs in short-term borrowings. They're relying a lot on a cash credit facility from Axis Bank, currently utilizing over 1,400 lakhs of it. They do have some long-term borrowings, sure, but it's really this short-term revolving credit that acts as their life support. The bank essentially fronts them the cash to keep paying their bills while they wait around for the Navy's checks to finally clear.
But, bank debt isn't their only lifeline. If we look back to June of 2023, the company executed an initial public offer, an IPO, issuing 5.2 million shares to the public. That massive influx of outside investor cash is exactly what allowed them to fund that explosive leap in revenue from FY23 to FY24, all without buckling under the sheer weight of their own inventory costs.
So, the core takeaway from all of this? Scaling a defense contractor is just fundamentally a different beast than scaling a software startup. The faster you grow, the more massive your upfront inventory costs become, and the more you suffer from delayed government payouts. You can be wildly profitable, but if you don't have a highly sophisticated strategy to manage your working capital and secure outside financing, you will simply run out of cash.
And the whole reason we even have these restated financials to look at is because CFF Fluid Control is actively pursuing a further public offer to raise even more capital. So as an investor trying to analyze this paradox, you really have to ask yourself, will this new influx of public money finally bridge their working capital gap once and for all? Or is running a negative operating cash flow simply the inescapable permanent cost of doing business at scale with the Navy? Something to think about. Thanks so much for joining me on this explainer. Catch you next time.